The Dunham Quarter in Twos gives you a concise outline of what we view as the most notable economic events that occurred this quarter, involving domestic markets, international markets, and the bond market, all in about 2 minutes. At the beginning of the first quarter of 2023, investors and governments alike carefully measured their decisions. Much like a ship's crew carefully measuring the weight distribution of cargo, the winds of inflation swirled in unpredictable directions, bringing both favorable and negative news in different months. Lower inflation is a crucial indicator for many investors since it could lead to the Federal Reserve reducing interest rate increases, thus easing the potential storm of a severe recession hitting the markets due to continued climbing rates. This uncertainty gripped investors much like a headwind slows a sailboat, as the possibility of an economic recession potentially impeding their investment progress loomed. Domestic markets. Just as even the best sailors cannot fully predict the direction of the wind, investors are equally challenged to project the direction of the equity market. Investors experienced a roller coaster ride in the U.S. domestic equity markets during the first quarter of 2023. Initially, they enjoyed a strong January, fueled by a strong finish in the fourth quarter of 2022 and some favorable economic news. However, they faced a downturn in February, followed by choppy but positive waters in March. Nonetheless, investors held on to a glimmer of hope amidst the volatile equity markets, with the steady job market offering some solace in an otherwise bleak economic outlook. Throughout the quarter, the unemployment rate remained surprisingly low, assuaging fears of a recession. Then, in early March, the perfect storm threatened investors' ships, reminiscent of the classic movie featuring George Clooney and Mark Wahlberg. As fears of a recession loomed in one direction, a new storm developed when Silicon Valley Bank, the 16th largest bank in the United States, came to a halt on March 10, 2023. Various factors, including failed investments and depositors' withdrawal of large sums of money, caused the bank's downfall. This same weekend saw Signature Bank falter, sending ominous winds and dark clouds over the market, with the financial press fearing other banks could suffer a similar fate. However, the regulators acted as an anchor, promising to make all depositors whole, even for funds not protected by the FDIC. The Federal Reserve took steps to boost confidence in the banking system and prevent future waves of bank runs that could have led to additional banking failures. For the quarter, the S&P 500, an index of 500 large U.S. companies, was up 7.48%, and the tech-heavy NASDAQ Composite Index, which tracks the performance of about 3,000 stocks traded on the NASDAQ exchange, was up 17.05%. Bond markets. The seas of the bond market have been rough and treacherous, but there are indications that they may be calming. Like skilled sailors reading the wind and waves, some investors predict that easing inflation could mean the Federal Reserve will not need to raise interest rates as aggressively as before. Possible lower inflation, coupled with a Federal Reserve with an eye on the economy due to the banking situation in this country, caused bonds in both the U.S. and international markets to rally, providing a glimmer of hope for those navigating these turbulent waters. For the quarter, the Bloomberg U.S. Aggregate Bond Index, which measures the relative performance of bonds in the U.S., showed a positive 2.96% for the first quarter. Similarly, the Bloomberg Barclays Global Aggregate Index, which measures the relative returns of global bonds, was up 3.01%. While there may still be storms on the horizon, this news provides a welcome respite and a reason to hope for smoother sailing ahead. International equity markets. The Eurozone entered the quarter on a high note, with promising waves lifting investor spirits and providing a hopeful outlook. However, inflation fluctuated unpredictably throughout the period, akin to the changing tides of the sea. Like their American counterparts, investors in the Eurozone faced turbulence as news of trouble at Credit Suisse emerged, casting doubt on growth prospects for 2023. Despite the choppy waters, emerging markets found support in lower inflation projections and China's unexpected departure from COVID-0 policies early in the quarter. With cautious optimism, investors looked ahead to the horizon, hoping for a smooth journey. However, as the quarter drew to a close, the winds of change blew again. But the MSCI ACWI ex-US index rose 6.87% over the period. As the financial landscape continues to shift and evolve, investors must stay alert and adaptable, prepared to alter their course to navigate the international waters that lie ahead. Moving forward. Just like sailors must stay calm and refrain from running about the deck of a ship in a panic, investors should remain calm and remember that investing requires common sense and non-emotional decision-making. Investors should work with their financial advisors to map the anticipated direction of the markets ahead as we sail into the second quarter of 2023. Please subscribe to our channel to stay up to date on the latest Dunham insights.